Last year, there was a viral clip floating around the internet of a rapper, Waka Flocka, pouring millions of dollars into life insurance and utilizing it as his own personal bank for investment opportunities.
Man, please, please, I'm going to open up an insurance, put $2-3 million in my insurance, and borrow from that and put it back in. I never lose my money, ever.
Psych! That's the wrong number!
When this clip hit the internet, every life insurance agent on the face of the earth was reacting to it in hopes of boosting their views and mainstream's appeal. It became the wild, wild west for people who didn't quite understand how insurance really works, but were leveraging the video as a marketing tool to get people to buy their product. But what TikTok and YouTube insurance agents who promoted this video failed to see was the atomic bomb that was coming their way. According to a statement from someone at a Primerica event that Waka Flocka attended, he claimed that Waka Flocka publicly admitted he lost $5 million to the same life insurance policy and that it was the worst financial decision he made in his entire life.
He admitted that he lost $5 million using this concept, and he said it was the worst financial decision he's made, okay?
I'm broke.
Now, while I can't 100% verify this statement, I think there's really important lessons that can be learned for anyone involved in the life insurance industry or interested in the infinite banking concept. If Waka actually lost $5 million to his life insurance policy, that means there was a massive gap between education and execution. Anyone who was actually educated and watched this clip of Waka would have seen the red flags right away. I actually posted a video before this all went down saying to be cautious about what he was saying. Here is my reaction on TikTok.
Here's a few things Waka doesn't mention. You can't just take $2 to $3 million and put it into life insurance one time. You have to put that $2 to $3 million into a policy for at least 7 years for it to be optimal. The last thing that Waka doesn't mention that's super important is that if you're using this policy for liabilities such as cars, houses, so on and so forth, this can negatively damage the strategy when using life insurance as a tool.
Unfortunately, many people have been sold a pipe dream. The dream is that life insurance will magically solve everyone's money problems. It would be like if I told you, go buy a hammer and you will magically have a house. It sounds crazy, but that is exactly what is being sold. Waka's influence has gotten him in rooms with a lot of really smart people. And the thing is, he's been learning a lot of really valid things. But it sounds like he just doesn't quite fully understand how this concept works. So now Waka has decided to take a different path, a path to buy term and invest the difference. This idea came from him being at a Primerica event, and that is usually how they sell their financial advice. So Waka went from do what the wealthy do and be your own bank to being represented by a company that demonizes cash value insurance. But maybe the strategy that Waka was doing wasn't the issue. Maybe it was the execution. So the question is, why are there other wealthy people, banks, politicians, corporations utilizing the strategy of borrowing against their cash value and successfully growing their wealth utilizing it? It's because they actually understand how it works. I believe that TikTok was the worst thing that happened for the financial industry because you get 10-second clips of the concept without education or context, and it hurts a lot of people. Everyone has a voice and everyone thinks that they are an influencer, which causes a massive misrepresentation of every product in the industry.
There's a lot of things in our industry that are amoral. Okay, there are a lot of things where morality is not involved, but there are pieces where morality is involved and misrepresentation is part of that. And it's not about IUL. There are misrepresentations in whole life and in VUL and in guaranteed UL, and I hate all that stuff.
If Waka had received the proper education on how cash value life insurance worked, this could have been his plan on how he could have executed on this concept and strategy. Waka's first step would have been to not commit to such a large amount of money going into the policy, especially knowing he was financially struggling already.
I'm broke.
So the better option, instead of doing $3 million, maybe would have been only $300,000. He would have had the mindset that this is a lifetime game and not a magic bullet. He would have contributed for at least 7 years, ideally longer. Most importantly, he would only use the policy to buy assets. You are using leverage when borrowing against your policy. So use leverage like the wealthy do and buy assets and not liabilities. So here's an example of what the policy could have looked like. Just to be clear as well, In this example, we are using overfunded whole life insurance, a specially designed whole life contract designed for cash accumulation. In this column, it shows $300,000 going into the policy. In the first year, he could borrow against the policy up to $227,000. He then should have used the cash value for his music career, business, or maybe something like real estate, but nothing else. After 20 years of funding, he would have over $9 million of cash value available, and he would have $22 million that he could have coupled with something like a trust to have his legacy live on forever. A huge benefit that likely wasn't shared with him was that this contract can be used tax-free as well, so you get tons of tax advantages along the way. Earlier, we shared a clip of Waka talking about the struggles during COVID. The amazing part about a whole life contract, when designed properly, in times of struggle, there are tons of flexibility with payment options. Instead of him contributing $300K during his financial struggles, he would have only needed to contribute $44K, which is like pennies to him. With his $3 million contract, he would need to contribute closer to $440K in times of financial struggles. The other big problem that I see, which is likely what happened, is when people get pitched the overly hyped infinite banking concept, which I am not a big fan of. Then what becomes a major problem is when infinite banking gets coupled and pitched with IUL. It is just set up for disaster.
IUL to me is fundamentally incompatible with IBC because it's too volatile. And if it is going to be compatible with IBC and you're going to make it work, you have to leave a lot of equity in the policy that cannot be loaned in order to make sure you can ride out the 2 or 3 years where things don't go in your favor.
You see, it's possible that Waka did not allow enough cash value to build up, and he used his policy too early. And if it wasn't an IUL, this could have caused the policy to lapse and lose money when he was likely using his policy for liabilities, not assets as well. At the end of the day, it all comes back to education and understanding how all of this stuff works. Don't buy if you don't understand, and don't criticize if you don't understand as well. Here on the And Asset channel, powered by Better Wealth, we want to be the voice of reasoning and help educate the truth about these products and what is really going on. At the end of the day, Waka may be better off buying term and investing the difference because it takes less education and it is easier to execute on. But on the other hand, I think he would be putting a ceiling on how much wealth and legacy he can provide indefinitely. Neither is good or bad. It just is. And at the end of the day, it's his choice. If you would like to continue your education on this topic, we offer tons of in-depth resources in the And Asset Vault. Click the link in the description as this is a free platform for you. I hope it helps you further your journey towards financial freedom and intentional living.